Welcome to Clockwise. This is where we discuss practically everything going around in the world stock market. And one of the perspectives we've shared here on several occasions is that we actually propagate the idea that diversification is one of the ways you can actually protect your portfolio in all aspects, in all times, as far as the stock market is concerned. And today, we want to take it a step further. We're not talking about just diversifying your portfolio only. We want you to also diversify to other economy. And today's conversation will be how to invest in the American economy from any part of the world, whether you are a Nigerian, a Ghanaian, anywhere in the world, you can actually invest and participate in the American economy. My name is Providence, and I'll be doing this as usual with my stock market analyst, somebody that sleeps on the chart, as I always re-echo on every show. Please welcome Mr. Ekata.
Thank you very much for having me. Thank you.
Welcome to Clockwise.
Thank you.
Today's conversation will just be for those who want to diversify their investments beyond the shores of their country. They want to actually participate in our economy, because most of our conversation are always around the American economy and the American stock markets. So I would like to ask you, would you advise somebody in 2026, let's say a Nigerian, to start investing in the American stock market?
Okay, thank you very much once again for having me. So here is the deal. It's important that as much as you diversify your portfolio among different asset classes, you also want to diversify across economies. If you get stuck in one economy, if something happens to that particular economy, you can see your portfolio tank. Apart from that, we saw a couple of years ago, for the past 2 years, we've seen a lot of things have happened, especially for those that were investing so exclusively in Nigeria. We saw at the time when the exchange rate was as much as almost 2,000 naira per dollar. So what you have as gain, when you look at it in absolute sense, was actually a loss. I'll give you an example. On a particular year, Transcore Hilton did 60%, 60%, but on that particular year, inflation was 36%. Okay. So if you look at, and apart from the inflationary figure, pressure, you also had that the exchange rate from the beginning of that investment cycle, the naira had dropped more than 40%, more than almost 50%, really, almost 50%. Yeah. And so if you combine the drop 50% and the inflation, which was around 36%, then you know that what you thought you had made with a 60% appreciation in the value of Transcore was actually, you were losing more than 20% in absolute terms. Okay. So that is a reason why you don't want to get stuck to one economy, because if anything happens to that economy, it's like literally you are having a table that sits on one leg. Okay. So that's how the challenge it could be.
One of the problem people usually have by diversifying to other economies, that they may not really understand the factors that affect that particular economy.
That is so. Yeah.
So can we have some other factors that we know? Okay, these are the factors that determine the direction of the U.S. stock market, for instance.
Okay, so I'm going to dwell so much on this because these are some of the things that investors have to really think about. I have had a couple of people that have called me. They want to invest in the U.S. stock market, and I just have to tell them that you don't just invest in an economy that you don't know how things work. Okay. You don't know what, especially you are investing in the stock equities, the equity market in those economies. You should know what actually influences those equities. So I'm going to take some time to really talk about the U.S. equity market. So the U.S. equity market is where you have companies in the United States that sell shares to the public to raise capital. And so what happens is investors actually buy parts of these companies into their portfolios. But there are some things that actually influence what happens to these companies. Like I've told you, and I believe everybody on this channel now knows that when we talk about the equity market, we are talking about tiny shares of companies.
Yeah.
Yes. So what affects the equity market, or what affects the economy of that country affects the equity market. In the last conversation, we talked about the fact that when oil prices go high, when we were talking about the Iranian conflict and all of that, and the impact on the market and the possibility of having a global recession, we mentioned that when prices are high, discretionary items suffer a lot. So companies that manufacture discretionary items take a hit. So that's why you have mostly tech companies get a very disproportionate hit and all of that. So in the US market, when you are investing, what do you look out for? The first thing you want to look out for is what is happening around inflation.
Okay.
Yes. When inflation is high, of course, the equity market goes in a galloping motion. You have gains. As a matter of fact, you see some companies that literally do to 100% return on investment.
Yeah.
Yes. So that's what happened when inflation, is high.
Okay.
But there's something that happens. The Federal Reserve in 1977, the U.S. Congress gave the Federal Reserve what we call the dual mandate. Mm-hmm. And the dual mandate is for the Federal Reserve to ensure stable prices as well as maximum sustainable employment. And so what that means is that the Federal Reserve has the mandate of encouraging or enhancing maximum employment, sustainable employment, by supporting the labor market. Mm-hmm. And they also have to combine this particular mandate with ensuring that doing their best to ensure that long-term inflation expectations are well anchored around 2%. That 2% is because, if the economy, that 2% is a figure that the inflation is not too high, so it doesn't erode the purchasing power of Americans. Okay. It is also not too low, so that people don't believe that, because that would be deflationary, meaning that people will believe that prices will go down in the future, so they will stop. If I tell you that this microphone I'm using, let's say it is 50,000 naira now, and then in the next 2 months or maybe 6 months, it will be, instead of 60,000, it will be, or 50,000, it will be 30,000. Would you buy it? Do you hold on? So that's what happens when you have a deflationary environment. So the 2% there means inflation expectation, long-term inflation expectation is well anchored around the 2% to ensure that people are incentivized to spend, but not too much. So
hoping that inflation will drop.
No, people are incentivized to spend. That's why we are talking about the 2% anchorage. So what happens is that when inflation is high, like in 2022, inflation actually hit as high as 9%. Think about that for a second. Above 9%. That was insane. So the Federal Reserve actually did the fastest rate hike in the US history. Took the interest rate, the federal funds rate. What is the federal? For the federal funds rate is the cost of borrowing. How much interest do banks pay for borrowing overnight? So the Federal Reserve uses this tool. That's literally like their basic tool that they use to tame inflation. So when the inflation is too high, the Federal Reserve does what? They increase interest rate, the federal funds rate. Let me call it interest rates. When they increase interest rate, they discourage borrowing because borrowing becomes more expensive. People can no longer afford to borrow and spend the way they used to. So when people don't spend more, demand for items. So it's the demand side of inflation that they are trying to fight. So people spend less. When people spend less, what happens? Companies will have to adjust prices. Okay. So prices will be forced down. But conversely, when prices are when inflation is low, the Fed would want to, like I told you, those two mandates are actually kind of opposed to each other sometimes. So because, watch this, if inflation is high, the Fed would increase interest rates. That means that corporations borrow at a higher cost. What do corporations do when interest rates are high? They trim their labor. So when they trim their labor, that means the employment part of the maximum sustainable employment part of the mandate is actually looked down on. So the Fed is actually trying to look at the prioritize in fighting inflation. Now, when that happens, they could risk a recession. Recession here meaning that demand crashes, labor employment rises. Once unemployment rises to 4.6%, then we are almost tipping into a recession. At that point, the Fed would do what? They would come in. By the time they realize that the inflation is well anchored around the 2%. Currently, we are still hovering around 2.4%. But once it anchors around the 2%, the Fed believes now starts a hike cycle. A rate reduction cycle. There's something I also had to mention, that apart from hiking prices, the Fed also reduces the size of its balance sheet. What I mean by that is when inflation is high, during recessionary environment, the Fed buys, in order to inject cash into the circulation, the Fed buys some assets. For example, like mortgage-backed securities. Mortgage-backed securities is like you bundling up mortgage products and put them in form of a product, productize it. So the Fed buys it. When they buy it, they inject cash into the economy.
All right. Now, from what you're saying, one of the problems people actually have, especially in other markets, let's say Nigerian stock market and the rest of them, is that they cannot accurately predict the happenings. From what you're analyzing now, the American stock market is more structured.
Yeah, definitely.
As an investor, you can actually foresee what you're doing. There are things that have been placed that you can use that to see the direction of the market. It's not like that when it comes to some other stock markets, some other markets. One government policy from anybody can actually just change the direction of the stock market, especially in Africa. Are you trying to say that the American stock market is more structured?
It is
more profitable.
So it is very structured because they have access to data.
Okay.
There was somewhere I was about to get to. So let me just wrap up what I said and then get to that. So the Fed actually uses that monetary policy to really fight inflation, encourage employment. When that happens, so when they raise interest rates, they fight inflation, but they most likely risk higher unemployment. And when they lower interest rates, the borrowing cost becomes cheaper. Borrowing becomes cheaper, and so people are most likely to spend more. Companies can hire more because they now have access to cheap capital, so they can now hire more and then, of course, expand. That's why you have an expansionary environment when the Fed starts lowering interest rates. And that's why, if you observe, a lot of investors like to invest when the Fed is on an interest rate reduction cycle. That's why if you look at even your charts, whenever the Fed comes out with a decision to reduce interest rates, you see the market jumps. Okay, so there is so much data. For example, you look at data like
what is Fed for those that just
the Federal Reserve. Yes. It's the equivalent of central bank in Nigeria. Yes. So the Federal Reserve they control all of that. They control the bond market. I was about to come to the bond market. So there is a lot of data. Things around unemployment. They have some very good figures around that. They have around inflation, the consumer price index. So the Fed has this data which they work with. Investors also have this data which they can predict the next Fed decision or where the Fed will be going, in its rate decision. For example, if it is CPI or PCE, though the Fed looks at PCE, but what is PC? It's basically, or what is CPI core? It's actually ex food and energy. So if you look at the headline and the core, you can predict if it's ticking higher, then you know that either the Fed will pause or the Fed would reduce. And then there's also what we call the summary of economic projections. So there are a lot of which actually tells investors what the dot plot gives them, what we call the dot plot, which is what do the Fed committee members, FOMC, that's Federal Open Market Committee members, think about where the rate will be at the end of the year. So because federal funds rate influence the performance of what happens in the bond market, investors monitor and try to predict or project into the future what the Fed's funds rate would look like. Now, that takes me to the bond market. So the bond market is where treasury, the US treasuries, where you borrow. The Federal Reserve sets what we call the benchmark interest rate, the federal funds rate. Every other thing, prime rate, auto loans, mortgage, are based off of the federal funds rate. So you can see how much the bond market controls every other part of the US economy. So including the stock market too. So what is the interaction here, and why should investors really look at, apart from the federal funds rate, which we have talked about first, which the Fed uses to fight inflation or to encourage employment, the bond market is also very critical. But the bond market relies so much on the Fed, the Fed stands, the Fed funds rate. Now, I want you to understand that the US treasuries are regarded as the safest assets in the world.
Give us reason.
And the reason is because the US dollar is the world's reserve currency.
Data.
And the US can actually print more money to actually do what? To service its debt. Do you understand that? So investors know that the US government will always pay back.
So it's better to diversify your portfolio.
So yeah, but I'm coming to something. So because of that, it is assumed that the US treasuries are risk-free. So if let's just say that the 2-year, or let's say the 10-year takes up to 5%, for instance, then tell me how someone would want to invest in 5%. I can take 5% risk-free. Why would I want to go and invest in a risky stock? Do you understand? So that is exactly why the bond market controls so much. When the bond yields go high, you know what happens? Investors sell their position. They sell out of the equity market to buy US treasuries. So what happens to the equity market? It collapses. So as an investor in the US stock market, you have to monitor what's happening in the bond market, because that gives a credible alternative. It is only when let's say we are in a funds rate reduction cycle, that the Fed can continue to reduce rate to its, now they are talking about the neutral rate is around 3.25%. Between 3 and 3.25%. That's where we are looking at the neutral rate. Now, if we get towards a neutral rate, that means that the stock market becomes more attractive, because investors will be looking to where they can get more gains. Currently, we have over $7 trillion that is sitting in money market funds, making, 4-point-something%. But if we did not have all of these conflicts, Iranian conflicts and all of that, which has led to a lot of spike in energy cost, which might also trickle down to causing higher inflation, the Fed was actually on a rate reduction cycle. The guy that is coming in, Kevin Walsh, is a guy that we believe wouldn't be as hawkish as Jerome Powell. So we thought, in fact, we came into this year with a projection of between 2 to 3 rate reductions this year. But as I speak with you, with what has happened, the oil is now at $118 per barrel. The prices of items are expected to tick up because of what we have in the energy market. What that means is that the Fed actually looks at what we call inflation expectation, not history. So inflation expectation has ticked up significantly, meaning that the Fed, that's why last week when we had the Fed rate decision, the committee decided to leave rates as is. And even in the conference, in the meeting, statements by the federal by Jerome Powell after the rate decision, he sounded very hawkish. So what that means is that you might have people are even projecting that there is a rate hike is on the table. While we should be in a rate reduction cycle, people are already projecting. If you look at Polymarket and Kashi, they are even projecting that there is a rate hike on the table. So what that tells investors is that the bond market will be more attractive. That's investors in the equity market. Bond market will be very more attractive. If it is going to be more attractive, that means it will have a very serious impact on the equity market. Already, as I speak with you this morning, the S&P 500 opened at 6,432, which means that that's about 8.25% from its all-time high. You look at names like Tesla. Tesla is now down 27% from its all-time high. You have Nvidia. You have the Max 7. They are down significantly.
But this is a result of the energy war, energy price.
Which is what I'm telling you, because energy price does what? Raises inflation expectation. Inflation expectation makes the likelihood of the Fed cutting rates to go lower and lower every single day. Now, even there's now less than 60% of a one rate cut this year. Do you understand? While the possibility of a rate hike is now ticking up to about 40-something%. So on the betting markets, on Polymarket and Kashi. So what I'm trying to tell you is that when this happens, when investors are monitoring the bond market very closely, that's one. Number two, because they know the effect that it has on equity market. Then the second thing I have to mention is what we call the yield curve. The yield curve actually tracks the spread, the difference between the short-term yields, the short-term debt and long-term debt. So if you look at when the longer end of the yield curve gets lower than the shorter end of the yield curve, what happens? That means that the yield curve is inverted. Since 1950, the yield curve has predicted almost accurately almost all the US recessions. So whenever the yield curve inverts, what do I mean? Let me explain a little bit about the yield curve inversion. So if I lend you money now, let's say, and you're going to pay back in 1 year, and I lend you money that you're going to pay back in 10 years, which one should I expect a higher interest?
10 years.
That's the long end of the yield curve. Good. But what happens is that when we are expecting recession, we are expecting recession, that means you are going to ask for more. You price in the long-term rate on a short-term bond. You want to get more because you are not sure of the near future. When you are not sure of the need, it's like now, if I know that ultimately you will be able to pay me back that over 10 years, things will straighten out. But I know in the meantime, you are still suffering with financial crisis. I would want to charge you more for the short-term debt that I'm offering you than the long-term debt. So that is what happens when a recession is in the horizon.
Yeah.
That means short-term interest rates get more expensive, require more compensation in terms of yields than long-term. That's why we say that the longer end of the yield curve is lower than the shorter end of the yield curve. That's what so investors, because of how accurate it has been Wall Street's check engine light for a very long time now. So investors are always looking at the yield curve. And I would always tell anybody that wants to invest in the US stock market, you should also look at the bond market, the federal funds rate, and the yield curve. You want to look at that too. Okay. Then the final thing I'm going to mention in terms of what you are supposed to look at in the US stock market is you want to look, especially if you are investing in things around like growth stocks, you want to look at were the economic policies of the administration.
Okay.
Let me give you an example. Last year, we saw what happened with the tariff shock. In reality, technically speaking, from an economics point of view, tariff is actually a one-time price hike. Yes, inflation is a yearly thing. So when I say inflation, it means compared to the price last year.
Okay.
And if I say 2%, that means every year we expect 2% higher value or price for an item compared to the year before. But because investors did not know how to predict, how to price in the effect of tariff, they thought it's going to be something that would lead to a gallop inflation. So guess what they did? They decided to sell out and protect themselves. So sometimes economic policies like the tariff, sometimes you might want to really look at the real impact. I remember when I told people, I said that tariff is a one-time thing. It's a one-time price increase. And no, it's not gonna. A lot of people sold out in April of last year. I can tell you by benefit of hindsight that if you had done that, you were a bundle of regrets by the end of the year.
Okay. All right. Now we've talked so much about the factors that will determine the direction of the markets, and let us also look at how to begin these investments. How do you start? Because I know if it's a Nigerian stock market, you just register with Bamboo, with Trove, with the rest of it, and those people act as middlemen to the market. Now, what are the tools you can actually use to start investing in the American stock market?
Okay, so because of we want this content to appeal to people that are starting very low.
Yeah.
You might also have to use some of those apps too.
Okay.
There are fees. I'm not going to promote any app here, but there are fees. Like Bamboo, you might be looking at a little above 1% to open a trade.
Okay.
Even deposit fees, there are fees too. When you deposit, for instance, if you're using Bamboo, first things first, you deposit in Nigerian Naira. When you deposit in Nigerian Naira, it will get into your Naira account. Then you can decide to do what? To convert it to US dollar. They will show you the exchange rate. Sometimes it's a little bit above, because of the arbitrage, it's a little bit above, sometimes about 20 naira above parallel market. So if you do that, you can exchange. Let's say you have 10,000 naira.
Yeah.
Let's, for ease of reference, it's around for 1,400. Let's say you have 14,000 naira now, and so you convert. That will give you about $10. $10 in your USD account, you can buy some stocks. It's that simple. Set up your account. You can use Bamboo, you can use Trove, you can use a bunch of them. But why I like to sit around some of those stocks too, because we've been around them.
You know a lot of Bamboo.
Huh?
You do Bamboo.
I do it, but I'm not promoting any. But the thing is that I can't sit down here.
You're a Bamboo ambassador.
I'm not a Bamboo ambassador. I did an unboxing last year.
Okay, Bamboo, remember?
Early this year in my office. Bamboo they sent me a very big.
I saw it.
You saw it. Okay. So they sent that, and but I'm not an ambassador though, but I appreciate what they did. I did an unboxing video too. But you can invest. It's very simple for you to invest. There is I think a deposit is about 25 naira. It's not expensive. Yeah. But if you deposit a large amount, I think it's about 100 naira. If you do like maybe 10 million and all of that, can be around 1 naira, 100 naira or something. So, but you change it to US dollars, it's going to get into your US dollar account within Bamboo. Then you can use that to buy US stock. You can do limit orders. You can buy on the spot. I would advise you do limit orders. And the reason is because if you buy on the spot, what you realize is, I mean, there are slippages, especially if the market is, at this point, the market is very volatile. When markets are volatile, then liquidity is thin. When liquidity is thin, the chances of you getting in at a price that you did not really, you can see the price like $4.50, $4.50. And then you place a buy. Before you buy, you now see that you actually entered at $4.90. It's not really because of bamboo. It's because when the market is volatile, the reality is that when you buy something, you're actually buying, we are buying from someone else is selling and you're buying.
Yeah.
So slippage is bound to happen. So that's why one of the things I always encourage limit orders. Limit orders means that at that exact price, once price gets to that, a bamboo would actually get you can actually buy an asset. So you buy it. When you buy, it's on your wallet, and you can also sell it the same way. You can sell. When you sell, you get the equivalent. But of course, like I said, if you are doing a dividend stock portfolio, remember 30% goes as tax. So yeah, 30% is reserved as tax. So you get, like, for example, I'm actually invested in a couple of dividend stocks.
Yeah.
So when the dividend comes because I know some people I know someone called me and told me, I was supposed to receive 100 now. These guys are giving me only 70 naira. No, sorry, $100. These guys are giving me $70. The fact is 30% has been withheld as tax. So you get the other one. You can decide to reinvest. Most companies in the US, they do quarterly earnings. Yes, they do quarterly earnings, which they pay if it's a dividend stock. If it's a dividend stock, at the end of the quarterly earnings, they will pay out dividends to some of their customers. If you have time, I would always say, I know that not everybody is a stock market analyst, not everybody is a stockbroker, but sometimes, like the Bible says, where a man's treasure is, that's where his heart is. You could have times, you could look at, if I'm invested in a company and I'm trying to build my future in this company, it's nothing for you to take out maybe 1 or 2 hours. You can
ask your questions in the comment section.
You can ask your question in the comment section. We're going to respond, but you can read company guidances. You can read their earnings, the details. You can join conference calls. You can join earnings calls, actually. You can join and just to be able to monitor, to know what is happening. And the projection. You don't invest based on a company's past performance. No. You invest in a company. The stock market is always futuristic. What the company is going to do in future. So if you can do that, that would allow you to do what? To manage your portfolio. No way. There are sometimes you could rotate from something to another. You take profits too. I tell people, listen, if you don't take profits, the market will take profits for you. Except you are something in a dividend or a long-term portfolio. There are some assets that I've sat on it for about literally 10 years now. If I'm doing anything, I'm buying, I'm scaling in. If you want to actively manage your portfolio, you could rotate for some assets. But if you don't know anything around stock and all of those things, you just buy and you sit on it. Compound interest will always get you to the finish line. But if you're a guy that understands a few things, you could rotate out of some assets into some other assets. For example, we saw what happened with the Mark 7. Investors have rotated from Mark 7 to some other names. That's why you saw that before this Iranian conflict happened, you saw that the equal weighted S&P 500 index was getting, I think it did about 5%, return on investment year to date at the time. So you might want to rotate from some assets to other assets. But before you do that, you have to look at some things. There are some numbers you have to look at. And this is very important. So you don't rotate out of an asset that is actually primed for explosive growth into an asset that is actually very dormant.
Okay.
You have to do that. We do our best on this channel to really look at some of these assets, and we're going to do more of them. Since we're now literally looking at the US stock market, we're going to pick some of those stocks and then do some analysis on them and then maybe drop a few updates from time to time on some of the assets that we believe, some of the stocks that we believe will do well.
All right. Okay, now let's assume I was just somebody that is into the stock market, and after listening to this program, I now decided, okay, I want to start investing in the American stock market in 2026. Now, speak to me as a beginner.
Okay.
What are those stocks you actually advise from your own analysis? Although you're not giving us financial advice.
Definitely.
Yeah, because which of those stocks will you say, okay, I should start from?
Beginners start from broad market index. Beginners, broad market index can do S&P 500. It's corrected 8%. Once it crosses 10%, that will be like very deep correction. And if it goes beyond that, that's now bear market territory. Good. So you might want to do S&P 500. You might want to do NASDAQ, US 100.
Okay.
That's the top 100 tech companies in the US. You might
QQQ.
QQQ. That's still like
Tech company.
Let me give you an example. That's still tech companies. But I'm talking about, for example, if you want to do the VOO Vanguard, those are the ticker symbols you see on if you look at the Bamboo app, for example, or your investment app. You look at Vanguard does it, Fidelity does it. Most of these companies they do it, so you can actually pick. I recommend Vanguard. It's easy for you to, and it is also it's sizable enough for any investor, because when people look at something that is about $500 something dollars, they feel afraid. But if you have something that's about between $40 and $50, people feel more comfortable getting in there. So you can do. Then if you want to go outside indices, you would want to, I think for me, Mark 7 stocks are becoming very attractive now.
Okay.
I'm telling you. These stocks are becoming very attractive. And the reason I'm saying that is that the fundamentals have not changed so much. Because remember, some of these Mark 7, for example, Microsoft, for example, Amazon, these are also hyperscalers that stand to benefit a lot from AI. And we know that this year is the year of AI.
Yeah.
So we have some of these names are becoming very attractive. You have like Nvidia is now back to 18 times earnings, which is a very attractive valuation for me. Most of the Mark 7 have seen some like high double-digit corrections. So for me, it is a very attractive buying opportunity that you can actually. And some of these guys are very resilient. They have huge balance sheets, very decent cash flow. So you might want to start from those names, the hyperscalers. They are the primary beneficiaries of the AI boom. The tech stock, companies like, even if it's not a hyperscaler, but most of these guys have the capacity to actually benefit from AI too, because they have a huge cash flow. They can invest in research and development of AI technology. So you want to look at those names first, starting out especially as a beginner, before you begin to go down the risk curve to look at other riskier names. So, like I said, the playbook is you start with the indices. You start with the broad market indices, the S&P 500, NASDAQ, the Dow Jones Industrial Average. You start from there. From there, you now move into the hyperscalers that are most primed to benefit from the AI revolution. Then you now move to the tech stocks. But in doing all of this, please try as much as possible to do dollar cost averaging, because if recession comes in, as we believe it will come in, then that playbook changes a little bit. You might want to stay away temporarily from the growth names and focus on the defensives.
Okay.
We had, if you want to know about the defensives, we talked about in the last episode. Thank you.
All right. Thank you very much. I think in our next episode we'll do more analysis on of different companies and their situation now, and how to get in. But for then, I think we should take conversation now. We should actually end it at this point to ensure that those who are following us for the very, very first time realize that what we are doing is to expose them to the US stock market and how they can start. Thank you for coming.
You're welcome.
It's a great pleasure. Now, on that note, we'll come to the end of today's episode of Clockwise. And also, do not forget to like, subscribe, and put on the show bell of this channel.